The interpretation of financial statements, ratio analysis. In this video, we're going to look at a question called Super Events Limited. We're going to work our way through the question and then work our way through the solution. There are further questions and video solutions available through my website, danielkingaccounting.wordpress.com. So, starting off with this question, and we start off at the top here. Super Events Limited produced the following financial information for the years ended 31st of March 2016 and the 31st of March 2015. So here we have an income statement and we have the information for 2016 here, and then to the right of it we have the information for 2015. Likewise down here we have the statement of financial position, the information for 2016, and then to the right of that the information for 2015. Now what are we asked to do? Well, just moving down a little bit, you are required to calculate the following ratios for 2016 and 2015. So we're asked to do the gross profit ratio, the net profit ratio, and we're going to use the operating profit, i.e. profit before interest and tax, PBIT. We're asked to do the return on capital employed, again using the operating profit, PBIT. Now those three together they can be classified as profitability ratios. We then have the current ratio and the asset test ratio. Those two together can be classified as liquidity. We then have inventory days, the accounts receivables days, and the accounts payables days. Those can be classified as activity ratios. And then finally down the bottom we have a debt to equity ratio, which will be a gearing ratio. So we've got four groups of ratios and we're going to analyze the ratios under these four headings. Now after we've calculated these, we're going to write a report to the directors of Super Events Limited that analyse the performance of the company over the 2 years, and what you're asked to do is use the ratios calculated in part A above and any other information that you deem to be appropriate. So to start with, we're going to take these first three ratios here, our profitability ratios, and we're going to set them up in a table. So what I'm going to have is three columns. I'm going to have a heading for profitability ratios. I'm going to have a heading here for 2016 and the previous year, 2015. And then down here, I'm going to write in the name of the ratios and the formula. So I'm asked to do the gross profit ratio, which is gross profit divided by sales multiplied by 100. I'm going to do the operating profit ratio, which will be the operating profit, which of course is the same as profit before interest and tax, PBIT, divided by sales multiplied by 100. And I'm also going to do the return on capital employed, ROCE. Now the ROCE will be the operating profit, PBIT, divided by the capital employed multiplied by 100. Now I'm going to calculate the 2016 ratios first, and then I'll do the 2015 ratios. You can follow along and make sure you understand it all, and remember at any stage you can pause and rewind and go over what we've done. Okay, starting off with the 2016 ratios, what I need is first of all gross profit ratio. I need the gross profit and the sales. So back to the question here, I can see there's my gross profit figure and there's my sales. Now you note that all these figures are in thousands, so what we have is sales of 250 million and gross profit of 70 million. I'll just drop off the three zeros and write them out as they appear here in the income statement. So in here I put in 70,000 divided by 250,000 multiplied by 100. If I multiply that out, that gives me 28%. Now the operating profit ratio, I need my PBIT, my operating profit, sales, which I've already used, and I'm going to multiply that by 100. So back here, operating profit we can see is here, PBIT, 25,000. So if I go back to my table here, so I have 25,000 divided by 250,000 multiplied by 100, and that gives me 10%. And then finally the return on capital employed. I have the operating profit, PBIT, which I've just used, and I need to work out my capital employed. Well, now capital employed is the ordinary share capital plus the reserves, which in fact is this figure here. So all these added up, plus the long-term debt. So the non-current liabilities, which is the debentures here, that's the long-term debt. So I'm going to add these two numbers here together, and that'll give me my total capital employed. So if I just take that over there, so I've got 75,250 plus 42,200. Adding those together, 5, 6, 7, 7, 8, 9, 10, 11. That's 117,450. So I'm going to pop that in here. So I'll have my PBIT, 25,000, divided by 117,450, multiplied by 100, and that is 21.3%. Now we're going to work through the 2015 figures. Remember, you can pause and rewind at any time. So for my 2015 figures here, I need the gross profit and sales. So I go back here. There's my gross profit figure, and there's my sales figure. So if I pop those in, I have 70,000 divided by 220,000 multiplied by 100, which gives me 31.8%. For my operating profit ratio for 2015, I need my PBIT, my operating profit. So if I just go back and look for that, that's the 28,000 there, and of course I've just used the sales, 220,000. So I pop those figures in. 28,000 divided by 220 multiplied by 100 is 12.7%. And then the return on capital employed, well, the PBIT, well, I've just used that, so I have that, is the capital employed I need to work out. So I go back here. So as we saw earlier, the capital employed will be the ordinary share capital plus the reserves plus the long-term debt. So ordinary share capital plus the reserves come to 60,500. Long-term debt, 28,000. So that is 88,500. So that's the figure I'm looking for. So back in here, I have my 28,000 divided by 88,500 multiplied by 100, which gives me 31.6%. So there the profitability ratios completed. I'm now going to move on to the next set of ratios, which were the liquidity ratios. So again, I'm going to set it up with my three columns. In the first column over here, I'm going to have the name of the ratio, and then I'm going to have 2016 calculations and the 2015 calculations. So here I've got my current ratio, which is current assets divided by current liabilities, and this is expressed as a proportion to 1. I have my asset test ratio, which is the current assets minus the inventory divided by current liabilities, and again it's expressed as a proportion to 1. So I'll start off with 2016, and I'm looking for current assets and current liabilities. So I'm going to find this in my statement of financial position. See, there's my current assets. There they are there. So that figure there, 118,700, that's the figure I'm looking for as current assets. And current liabilities, here they are down here, and it's 66,750. So there the figures are going to pop in. 118,700 divided by 66,750, and to express that as a proportion to 1 is 1.78 to 1. Now I'm going to do the asset test ratio, which reads the same thing of my current assets, my current liabilities, but I'm going to remove the inventory from my current assets. So back to my question here. Here's my current assets. Now there's two things you can do here. You can take the 118,700 and subtract 45,500 from it, or you can just add up the other current assets. In this case, it's easier just to add these two together. That won't always be the case, but that would give us 73,200. So that's my current assets minus my inventory. So back here, 73,200 divided by the 66,700, so the current liabilities haven't changed, and that will give me a proportion of 1.1 to 1. Now I'm going to look at the 2015 figures, and don't forget you can pause and rewind at any point. So for 2015, again I'm going to look at my current assets. So there's the figure there, 99,300, and my current liabilities, 75,800. So I pop those figures in, and I get 1.31 to 1. And then for my asset test ratio, I'm going to take the current assets that I have here, but I'm going to remove the inventory. So let's just have a look at that. So I'm going to remove 42,500, which will leave me with 56,800. So if I go back here, I got 56,800 divided by 75,800 to 1, which gives me 0.7521. Now, my third set of ratios will be my activity ratios. Again, same thing, 3 columns. I've got my ratios here. I've got 2016 calculations and previous year 2015 calculations. My 3 ratios here, inventory days. Now that is inventory divided by cost of sales multiplied by 365, and of course 365 is the number of days in the year. The accounts receivable days, which is the accounts receivable divided by sales multiplied by 365. Again, it'll be the number of days. And the accounts payable days, well, that is the accounts payable divided by purchases, except in this case we've got cost of sales written in, multiplied by 365. And the reason we're going to use the cost of sales is that in situations when purchases are not available, use the cost of sales instead. Now, we've been given a highly summarized income statement. We do not have the purchases figure. So we are actually, in this case, going to use cost of sales instead of the purchases because the purchase figure is not available. If the purchase figure was available, I would prefer to use the purchases. So, doing the first one, inventory. I need my inventory and I need my cost of sales. Back to my question. I know I'll find the inventory under current assets, 45,500. And my cost of sales is up here, sales less the cost of sales, so it's that figure there. It's the 180,000. So I'll pop that in there. 45,500 divided by 180,000 multiplied by 365 gives me 92 days. So there's approximately 92 days of inventory sitting on the shelves. The accounts receivable, so if the accounts receivable, which is the current asset, divided by sales. So back to my question. There's my accounts receivable, 71,900, and up the top of the question, there's my sales, 250,000. So pop that in, 71,900 divided by 250,000 by 365 gives me 105 days. And then finally, the accounts payable days, which would be the accounts payable and the cost of sales. So let's have a look at that. Accounts payable is the current liability. It's down here. 60,500, and the cost of sales up here, I used that a few seconds ago. If you can still read that, it's 180,000. So 60,500 divided by 180,000 by 365, and that's 122 days. Okay, now I'm going to pop in the figures for 2015, and do remember, as I said earlier, you can pause, rewind, and play again at any point. So for 2015, I need for my inventory days, I need my inventory and my cost of sales. So back here, inventory is a current asset, so there it is there, and my cost of sales is this figure up here, 150,000. So pop that in, 42,500 divided by 150,000 by 365 gives me 103 days. For my accounts receivables days, I need accounts receivables and sales. Accounts receivables would be a current asset. So there it is there, 55,600, and the sales, 220,000. 55,600 divided by 220,000 multiplied by 365 gives us 92 days. And then finally is the accounts payable and the cost of sales. The accounts payable, of course, is the current liability, so 68,800, and the cost of sales, the 150,000. So pop those figures in there, multiply by 365, and I get 167 days. So finally, we're going to look at the gearing ratios. So again, same layout, got my heading over here for my ratios. Well, only one ratio in this case. I have 2016 calculations and 2015 calculations. And I'm going to do a debt to equity ratio, which is long-term debt divided by equity multiplied by 100. Now I need to go and find that information. So my long-term debt will be under non-current liabilities, and it's the 42,200. In this case, it's debentures, but any sort of long-term loan could be included. And it's to equity, and equity is the ordinary share capital plus reserves, so it's the 75,250. So if I pop that in, 42,200 by 75,250 by 100 gives me 56%. And then the previous year comparison, let's go back here then, we have the debentures 28,000 and the equity 60,500. So popping those in there, multiply by 100 because it will be expressed as a percentage, and we have 46%. So they are the 9 ratios that we were asked to do completed. So if we just go back here, we can see we were asked to do these 9 here. We've now done them all. So we're just going to write up our report now. So in writing a report, we're going to have a little introduction. We're going to discuss the ratios under our 4 headings: profitability, liquidity, activity, or sometimes referred to as efficiency, gearing, and then we have a little conclusion. Now, what I'm going to put here is items that I believe should be brought into a discussion. So this isn't sort of a de facto discussion. This is the sort of thing that you should be thinking of mentioning in your own discussion. So a little introduction. Well, this report analyzes the performance of Super Events Limited over the 2 years. So I'm just stating what I'm doing here. 2 years being 2016 and 2015. And I'm going to analyze the performance under the headings of, well, it's exactly what I'm doing: profitability, liquidity, activity, are sometimes referred to as efficiency, and gearing. So that's my little introduction, and then I'll move on, and I'm going to discuss profitability. Now, I'm going to talk about the ratios, but I just want to regurgitate the ratios. I'd like to look for something different. Now, a lot of the ratios revolve around sales, gross profit, net profit, and so on, so I might start with sales. So what I could say is that the sales, or the turnover figure, has increased to 250 million from 220 million. This is an increase of approximately 13.6%. So that's a nice little start, setting the scene. Now we also note that the gross profit ratio fell to 28% from 31.8%, but the actual gross profit was constant. So what happens here is the margins have been squeezed, but they're making the same profit because the turnover went up. The net profit ratio fell to 10% from 12.7%, and the actual net profit fell to 25 million from 28 million. So that wasn't so good. And of course, the return on capital employed was also down. So it's just a little discussion on the profitability. In terms of liquidity, what could we say here? Well, the current ratio seems okay. Rule of thumb would be about 2 to 1, and it's not really a million miles away from that. It's 1.78 to 1 if you look back. And the asset test ratio also seems okay. Rule of thumb would be about 1 to 1, and it's 1.1 to 1. Now, these rule of thumbs are the norm for certain industries, but for other industries it could be totally different. So you need to be careful of what industry you're looking at when you mention this rule of thumb of 2 to 1 and 1 to 1. But generally speaking, there doesn't seem to be any real liquidity issues. Moving on to activity or efficiency, while I just mentioned the different ratios here, the inventory days have improved to 92 days from 103 days, so the lower the better, but they still seem very high. I mean, that is an average of 3 months stock practically, or 3 months inventory. The receivables days, they have increased to 105 days from 92 days. Okay, that is a cause for concern. So it means on average people are taking 105 days to pay, so they're very slow paying, and they're even slower than last year. So that is a problem. And payables days are very high, but they have declined. So they have declined to 122 days from 167 days. So that means on average, super events are taking 122 days to pay their suppliers. That's very long. The danger here is that the suppliers would stop supplying. And then finally the gearing. Well, the gearing ratio has increased. It's gone up to 56% from 46%. Is this high? It's very hard to say. It depends on so many factors. It doesn't seem extraordinarily high, but then we don't really know enough about the business to make any judgments. So now what I'm going to do is I'm going to have a little conclusion, and I'm just going to focus in on a couple of points that I think are key. So the conclusions. Well, what I'd mention here is that despite the increase in sales, already mentioned, increase of 13.6%, the gross profit margin and the operating profit itself, in monetary terms, are down. So remember that the gross profit margin fell to 28% from 31.8%, and the actual operating profit was down to 25 million from the 28 million. So that's not good. That would be a cause for concern. Margins down, profits down. And the second thing I think would be quite important to mention is that receivable days have increased to 105 days from 92 days. This is really a cause for concern. People are very slow paying. I mean, if that's the average period, 105 days, are people going to pay at all? Could there possibly be bad debts in there? These are areas that should be investigated. So if I was making a recommendation to Super Events Limited, I would say that these are the two key areas that I think they should look at in detail. Okay. That brings us to the end of this video, which looked at the interpretation of financial statements using ratio analysis, and we used Super Events Limited as our question, and we worked through and discussed the solution. Thank you very much.